I think they're going to see a pretty nasty sell-off in gold at some point. Listen, I'm a big fan, so let's not. This is a trader speaking right now. Okay, I'm a big fan of gold. I think we're going to see 2,700 again before the year's over. Okay, I thought we'd hit 3,500. We're well overbought. I think what's perpetrating this rally right now that we're continuing to see is as I've always said to you, there's not enough gold in this country to cover the amount of paper that's written on that gold. Right, so you're seeing a little bit of a short squeeze once again, but I do believe that cooler heads will prevail. I think you will see some selling. Certainly, I would not sell any of my physical metals. I would, as a trader, I don't mind being short, but I'm never giving up my physical because we both know that it grows over time.
A bullish reversal in gold suggests a likely continuation of its upward trend, supported by strong technical signals and a breakout that may lead to higher prices and potentially new record highs. The recent rally in gold has been marked by momentum and strength, with the price surging rapidly. However, according to Todd "Bubba" Horwitz, this pace may not be sustainable in the short term. He expects a pullback, possibly to around $2,700, before gold resumes its ascent, potentially reaching as high as $3,500 later this year. Horwitz attributes much of the recent rally to a short squeeze, driven by the imbalance between physical gold availability and the volume of paper contracts written against it. After hitting a record high near $3,500, gold experienced a relatively shallow pullback to $3,202, forming a classic bull flag pattern. The price's strong reaction from these levels indicates a healthy uptrend. While gold remains the focus, Horwitz also draws attention to the gold-to-silver ratio, which has climbed above 100 to 1. This suggests that silver has significantly underperformed gold during the recent rally. Silver and platinum may present better short-term trading opportunities, as they appear less overbought and could deliver larger percentage gains during any catch-up move. However, not all analysts agree on silver's potential to close the gap with gold. In a note released Monday, Goldman Sachs stated that gold will likely continue to outperform silver, citing sustained central bank demand for gold as a key factor that has structurally lifted the gold-silver ratio. The ratio currently stands near 102, up from around 84.7 a year ago. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think they're going to see a pretty nasty sell-off in gold at some point. Listen, I'm a big fan, so let's not. This is a trader speaking right now. Okay, I'm a big fan of gold. I think we're going to see 2,700 again before the year's over. Okay, I thought we'd hit 3,500. We're well overbought. I think what's perpetrating this rally right now that we're continuing to see is as I've always said to you, there's not enough gold in this country to cover the amount of paper that's written on that gold. Right, so you're seeing a little bit of a short squeeze once again, but I do believe that cooler heads will prevail. I think you will see some selling. Certainly, I would not sell any of my physical metals. I would, as a trader, I don't mind being short, but I'm never giving up my physical because we both know that it grows over time. But I think this rally is a little bit too well overdone. I think we're way too far. This goes to the other side of what we talked about earlier, the 200-day moving average. We're about 7 or 8 standard deviations away from the 200-day moving average to the upside, which is way too strong and way too fast. And of course, if you then tie in the silver-gold ratio, which is well over 100, it doesn't work that way. And at some point, again, we saw it last week a couple of days. We had a $140 down day last week. And I think you're going to see more of those coming forward. Long term, buy gold, forget about it, put it away. Short term, I look to sell it. I think it would narrow because silver wouldn't go down as fast as gold. Silver has not participated anywhere near in the rally that gold has had, right? We went from 90 to 1 to over 100 to 1. Right now, as you and I are speaking at this minute, the ratio is over 100 to 1. Okay. So even if gold goes down to 2,700 and silver goes down to 30, then we're back under 100, right? And I would look at that type of ratio. I would think that it's going to come down. And remember, the original ratio was set at 15 to 1, and now we're just a little bit above that. When I first started talking about the gold-silver ratio, we were in the 70s. Now we're in the hundreds. I think that silver's an outstanding player. I also think platinum's an outstanding player because I don't think they'd be as damaged. I mean, you want to trade a futures trade, sell gold, buy silver, buy platinum. I think you have a much higher probability of bigger profits. Again, I think that gold is due for a pretty good beatdown, whereas silver really hasn't done anything all too exciting. I said I thought it would get to 35, which it did. But again, I think it will go higher. But I think, again, lower first. I think the markets are going lower first. I think gold is way too, mathematically, way too far from the mean. I don't think there's enough money to support the kind of movement we're seeing right now. If you follow a market theory, which is the bulls live above the 200-day moving average and the bears live below, we are now back to approaching the 200-day moving average as resistance. So this rally is no surprise. The markets typically get oversold or overbought. And now that we're reaching that 200-day moving average, I would expect that these markets will fail pretty heartily from here. I'm looking for a good spot to short and look for back to lower prices. I think we're going to take out the lows we put in over the last down move. But again, just from theory, again, we go back, you rallied back to resistance, which is the 200-day moving average. I expect the market to sell off from here.
President Trump has continued to pressure the Federal Reserve to lower interest rates, criticizing the central bank on social media for being too late and wrong in delaying further rate reductions. Despite this, the Federal Reserve is widely expected to keep its benchmark interest rate unchanged at its meeting on May 7th. According to CME Group's FedWatch tool, there is a 97% probability that the Fed will maintain the federal funds rate within its current range of 4.25% to 4.5%, a level it has held since its last cut in December. While political pressure mounts for looser monetary policy, not all market observers support the idea of rate cuts. Todd "Bubba" Horwitz is among those who strongly oppose further reductions, arguing that lower rates would do more harm than good. In his view, cutting rates would exacerbate inflationary pressures and primarily serve to bail out over-leveraged banks rather than support the broader economy. This divergence in perspectives highlights the growing debate over the future direction of U.S. monetary policy. While Trump advocates for lower borrowing costs to stimulate growth, analysts like Horwitz caution that short-term relief could lead to longer-term instability, especially if inflation accelerates. Let's get back to the interview.
I mean, again, I can't tell soon. That's always a hard question, right? I can't time the market like anybody. Nobody can really time it. But the next down move, I think, takes out the previous lows we put in the NASDAQ, in the S&P, and in the Dow. I think we do hit my target of 40 to 60% to the downside. Again, it's not going to be fast, but there's still going to be a lot of pain in this overall market. And right now, one of the biggest problems we're seeing from a trading standpoint is the volatility is too high, the volume is too low, which creates a market that is not liquid, which is why we're getting some of these moves we're getting. As much as President Trump wants them to cut, they better not cut. It would be a very big mistake for the Fed to cut rates. Again, that's going to create higher inflation. I understand our debt, I understand our structure, but I think they're pricing in there will be no rate cut, and I do not believe there will be a rate cut this particular cycle. Remember, and I just want to remind everybody, go back to September when they first made their first cut. Your interest rate as a borrower is about 100 basis points higher. The bank's borrowing rate is about 100 basis points lower, which means that the only body did any good with their last rate cut was the banks. Well, I think the banks are in trouble. I mean, again, I'm not going to change my view here. I think they're over-leveraged, and they're only being held up artificially here by the Federal Reserve and by what they've done. Hence, the rate cuts were for the banks. I think banks are in very, very big trouble. Again, we don't hear about it until it's too late, but there are many warning signs out there, certainly with the smaller banks and the regional banks that have a lot of trouble already. And I think the big banks, again, are over-leveraged as well. And again, remember, we're going to hear, and somewhere there'll be some news that we'll hear that the banks are actually in trouble. But I mean, the mortgage rates, although we had a decrease of delinquencies in March, they're still at record highs, or highs since we haven't seen since 2011. So the lending, the borrowing is a big problem. I think it'll be worse than that. Again, I think we built a country based on, lousy jobs. Although the jobs number last Friday was decent, they're not high-paying jobs. We're still spending more money than we're making. And I think that the banks are in for a pretty good beating, which again will really penalize you and me, the taxpayer, because we'll end up having to bail them out once again. So I think that again, I would say that the economy itself, and we expected this, we expected some pain for Trump to get what he wants and to get the economy back on the right track. There is going to be some pain first, and it'll include the individuals, it'll include the banks, and I think that again we're just going to be the very first quarter of the trouble that we're going to see. He could be the catalyst initially, but I think again, we can't look anything from day to day, week to week, or month to month. We have to look over the time and the strength, and the tariffs have been a very big win. I mean, we have collected over $100 billion in tariffs. In fact, we got $17 billion in April from the tariff exchange. So again, Trump will never get credit for anything. We all know that if something goes wrong in your life, just blame President Trump. It doesn't matter what it is. So we all know that's part of the cycle. But I think Trump is doing 100% the right thing. I think he's taking back over control of the world. I think he's putting us back on top of the board instead of on the bottom, and instead of being the laughing stock. I think China's getting a lot of trouble. You never get good information out of China. You never know for sure. I think they're in a lot of trouble. I think many other countries are in a lot of trouble, but I think we have the opportunity to pull out the fastest and turn it around the fastest. But we have to stick to a plan, which is, I think, is what President Trump is going to do. And I think that's what ascent is telling you, that we're going to go through this plan. And yeah, we're going to suffer a little bit. There's going to be some pain. But once we get through the pain, once we get jobs back here, and I'm not talking about the $12 an hour jobs that most people have. I'm talking about real jobs that people can make real money. I think we start and turn it over once we get to that point. But it's going to take time and some pain to get to that point.
A notable technical breakout and limited physical supply have contributed to upward momentum, though near-term corrections are not ruled out. Meanwhile, diverging views on interest rate policy expose a deepening rift between political agendas and economic prudence. While some advocate for stimulus through monetary easing, others warn of long-term consequences such as asset bubbles and inflation spikes. In this complex backdrop, traders are weighing opportunities in gold and lagging metals like silver and platinum that may present favorable entry points. In a climate of policy uncertainty and shifting investor dynamics, how might precious metals continue to serve as a barometer for economic confidence and market stability? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.